Hey dividend investors, today I'm going to be giving you an idea of what a covered call ETF really is. Let's get down and let's check this out. So really quickly, what are the bonuses of a covered call ETF? Well, one of the biggest reasons why you would want to invest in one is because, of course, they're usually going to be paying a very high dividend. And why can they pay that? Usually what happens is, of course, they do hold a long position in companies. And these are usually banks or oil companies, maybe gold miners sometimes. And they pay usually, these stocks at least, usually pay around 4%-ish. Depends on the country, depends on the company as well. And you're probably wondering, well, why do the dividends in these covered calls usually equal 8% or usually double this average number of what the companies actually pay in dividends? It's because they are using a covered call strategy. Now, what is a call? A call is an option. And an option is basically betting on the market to go up if it's a call, and if it's a put, it's betting on the market to go down or the individual company to go up or down. So basically, a call option is betting on the company to go up in value, while a put is to go down. If it's a covered call strategy, basically what this does is now they are selling calls against the companies that they hold long term. So when you're holding a stock long term, let's say we are holding TD Bank long term, we are looking at a long term return of it going up in value, being a plus. Meanwhile, when you're selling a call, you are betting that the stock is going to be going down. So you would think that this would equal out to be zero. However, it doesn't equal out to be that way. Basically, what this is doing for you is when this stock, for example, is going up, then that means that you are making money. However, when you are selling calls, you are still making money because now you're selling those calls to people who are buying those calls. And what that does for you and why this makes you money still is because now when it comes to the buying and selling of calls, when you sell a call option, you now make the premium back. Now, without getting too in-depth on what a option really is, there's two inherent values that you're basically looking at on the basic side of things, and that is the underlying company value, if that goes up or down, the actual options premium, which is what the option costs, goes up and down, and that fluctuates faster and higher and lower than the actual stock itself. I'm just trying to get this the most basic as I can so that everyone can understand what this is without having to go into the whole history of what options really are. So what does this all really mean when it comes to the mainstream average investor? Let me explain this to you. So, for example, when you look at ZWK, which is an ETF up here in Canada, it's a BMO ETF. And when we're looking at this, how does this stock go up and why does it go down? So, first off, it will perform best when the stock, for example, Wells Fargo, because that's an American bank, does either this type of a chart where it slightly goes up but doesn't really do too much. ZWK is going to outperform the stock itself. If, for example, Wells Fargo does one of these, then ZWK is not going to be performing as well as this stock because now you're betting against this to happen. However, because of the premiums, you are still going to be getting a plus and probably not as high, but you'll probably get one of these. So there's still going to be that difference, but you are making that money back by the premiums of the options that are being sold. So even though your underlying value is not going as high as Wells Fargo, what's really happening is you're getting paid back in form of a dividend. And that happens no matter what. Now, when the stock itself goes lower slightly, like this, you're still going to be making and probably outperforming Wells Fargo, and you might be going about even at that point. However, recently, we have had the worst crisis the world has ever seen, probably, and that is the coronavirus, where the stock just basically went like this. And when this happens, your covered call ETF is also going to be going down, however, not to this extent. And the idea behind a covered call option strategy is basically you are going to be making more money when the stock does nothing or when the stock goes down slightly. If the stock plummets, it's going to protect you on the downside, but if it's going up huge, it's not going to be doing as well. However, you are still going to be increasing your underlying value at a good amount, and the benefit to this is going to be the premiums that you are making and being paid out as a dividend. At the time of making this video, ZWK is currently paying around 8.5%, and I picked it up a few weeks ago at 10% of a dividend, which is fantastic. So if you're looking for some passive income, this is a great way to be able to do that. I hope that this video has kind of explained to you how a covered call ETF works. This is the layman's term, the most basic possible. I hope that you've enjoyed. I'll see you guys again in my next video.